Welcome to the Advocate Insurance Desk. We are your hosts. I'm Katie Dowson.
And I'm Grace Schmidt.
And we're so happy to have you listening. At Advocate, we track and analyze insurance data across multifamily assets throughout the U.S. And on this podcast, we're using that data to explore what's actually happening in the market, not just what people think is happening. And our goal is simple: to replace theories and anecdotes with actual visibility, context, and facts. So owners, lenders, and operators, or anyone who touches risk or commercial insurance, can better understand how that insurance pricing works and where it's headed.
We're going to be analyzing and discussing why insurance pricing has quietly become one of the most important variables impacting deals, underwriting, and even housing affordability.
And if you're watching along on YouTube or on Spotify, you'll be able to see a live banner of market indices pulled directly from the Advocate Market Terminal in real time. So this is real information straight from the terminal. And today we're going to be focusing on two of those indices. Grace, can you give us a quick overview of what data we're going to be diving into today?
Yeah. So today we are zeroing in on two New York City multifamily indices, property and general liability. We're looking at the year-over-year rate on line changes for each of those lines, identifying and analyzing why those two lines are behaving differently right now, and what is the driving force behind that difference in behavior.
Great. Now, I want to dive a little bit deeper here and actually pull these directly into our platform. So if you're watching, you'll be able to see on your screen. I'm going to look at New York City here, and let's start with those headlines, Grace, because they're pretty striking. I mean, I think most people listening are not surprised to know that insurance pricing is going up. It's going up nationally. They've already felt that. But liability up 60% and property up 30% is kind of wild.
No, it is wild, Katie. And I think we can all agree we have felt like insurance prices have been increasing across the board. I mean, even me as a renter, I feel it. But especially within commercial real estate, it's really been increasing. But what's the most important thing to take away when looking at this data is actually the fact that liability coverage and property coverage are no longer moving together. And not only are they not moving together, the difference in magnitude in how liability and property rate on lines are increasing is super different and very wide. And that increase in ROL that we're talking about, Katie, is not just a marginal increase. It's a material effect. It materially affects insurance underwriting assumptions and deal viability, especially in New York City. So while we see both property and liability increasing, what's important to note is that the difference in how they're increasing and the fact that they're no longer moving together.
I feel like that's really good context. Another piece of context for New York City I feel like we should touch on is the political context.
For sure.
We just had a change in mayoral leadership with Mayor Mamdani. He ran on a platform centered on some really momentous and important issues like housing affordability, stronger tenant protections, and expanding multifamily development. And the policy direction is already being closely watched by insurers.
Okay, but Katie, not to interrupt you, why would insurers care about Mayor Mamdani's housing affordability plans?
That's a good question. I mean, none of that really sounds like it should directly impact insurance pricing. But insurance doesn't always wait for policies to be enacted. Insurance is often priced based on many things, but one of those being expectations. So when insurers are looking at a political platform such as Mamdani's that emphasizes things like expanding tenant protections or changing eviction processes or increased enforcement around building conditions and habitability, they start modeling how that could change claims behavior over time.
So essentially, you're saying that pricing is changing almost preemptively. Like insurers aren't doing it because there's something happening now or a change happening now. They're preempting that change.
That's right. For example, even discussions around strengthening tenant rights or expanding access to legal remedies or, shifting how disputes are resolved can affect how insurers think about frequency and the severity of liability claims. This is especially relevant in a market like New York City, where litigation has historically been more plaintiff-friendly to begin with.
Right. So insurers are basically asking, what does this mean for lawsuits and potential litigation, not just changes in policy? And honestly, I mean, Katie, this makes sense, especially when we look at the increase in liability pricing year over year, especially in New York City.
Yeah, and at the same time, this mayoral administration is also focused on expanding multifamily development and improving housing affordability. So those goals make sense. Those are great goals to have, but there's a real tension here.
I mean, I think the tension is resulting because insurance is no longer just a line item, right? It's not something that you just forget about. It's one of the factors that can make or break a deal, like building a new affordable housing complex.
Yeah, insurance has quietly become one of those core feasibility factors for developers, owners, and lenders. So when liability premiums rise materially, like you're showing here, Grace, the cost it's not sitting alone, it's not sitting in isolation. It actually flows straight through underwriting, NOI, and ultimately into decisions about whether projects actually pencil or actually work out.
So I think you bring up a really good point, Katie, talking about deal viability and whether or not a deal actually works out. What's critical about how liability affects deal viability is that even though these policies are aimed at affordability, deals can end up facing friction if insurance costs aren't fully understood or correctly anticipated. Because, as you said, Katie, when insurance is more expensive, the total cost of a project or deal increases, right? And so with an increase in the cost, that reduces the overall income and overall revenue that somebody could generate.
Exactly. But at Advocate, we're always diving into the data, but having these conversations today, what we're aiming at here is understanding how these insurers interpret policy signals and reprice risk accordingly.
I think it'll be interesting to see how the Mamdani administration handles these affordable housing complexes and different policies. And, not to take it away, but Mayor Mamdani, if you are listening to this podcast, we would love to talk with you about how liability prices can affect affordable housing viability.
Yep. You know where to find us.
Great.
Very nice. Okay. Grace, let's talk about that divergence we mentioned earlier. So I'm looking at the charts here, and our viewers will be able to see that. Our platform is showing the changes in ROL for property pricing and liability pricing over the past year. So just to level set, this is the cost of protecting multifamily units in New York City. But beyond that, can you tell us a little bit more about what that data is actually saying?
For sure. So when we look at the charts, we can see that property pricing appears to be starting to level off, especially within the last 6 months. So we're starting to see kind of a plateau with property pricing. Okay. Liability pricing, on the other hand, continues to move upward with no real sign of slowing at all, Katie. I mean, it's drastically increasing. And this tells us that unlike, during, for say, the COVID era, when COVID was the main driver behind pricing movement, the drivers behind these two changes in pricing for each two lines of coverage are actually fundamentally different right now.
So what's driving that continued pressure on liability? I know we mentioned earlier that the Mamdani administration proposed policy is affecting the way that insurers price risk, but this pricing change has been happening over 12 months, and Mamdani's policy has really just been coming into play and into the public eye over the past 6 or so months. So what other factors do you think we need to consider?
So with regard and respect to property, the rate of natural disasters has actually done what we called flow through, meaning we are seeing pricing starting to level off because insurers, preemptively priced for natural disasters and property coverage previously, and that's now flowed through the market, resulting in a leveling off effect. Whereas liability is obviously increasing at a significant rate. And a major factor to that is the 50% increase in nuclear verdicts over the last 12 months.
So we'll put up a chart here, but Grace, do you mind defining what a nuclear verdict is for those of us that don't get to, unfortunately, sit with you every day and hear all about this, or if you're not a litigation nerd out there?
Yeah, so a nuclear verdict is essentially when the jury awards a payout of close to 10 to hundreds of millions of dollars. It's a verdict that exceeds your expectations for what you thought a plausible payout could be.
What happens when there's an increase in nuclear verdicts against insurance carriers?
So a couple things. So when insurers see massive jury awards, they start to assume future losses that could be huge, right? They're seeing their competitor hit with a claim of $100 million resulting in a $100 million plus jury verdict. And they're saying, oh my gosh, That's way bigger than what we would have ever expected a loss to be. So they start to assume that their future losses will be huge, and then they start to increase their premiums. Now, the natural question one would ask is, okay, well, why increase the premiums? And the reason they're increasing their premiums is to increase the amount of capital they have on hand for, potential lawsuits or payouts that could occur. And this results in entire industries getting hit with increased premiums. Even companies that have never had a claim, completely clean loss histories are going to end up paying more for their insurance coverage strictly because the entire industry is being hit with increased premiums. Because protection across the board is rising, because insurers are now concerned about the potential litigation risks and nuclear verdicts that they could face. But again, none of this really answers why we saw an increase by 50% in nuclear verdicts, right, over the last year. And the answer to that really resides in what we call litigation funding.
Okay.
Are you familiar with litigation funding, Katie?
Tell me more.
I would love to. So litigation financing plays a huge role. And that's when an institutional investor funds lawsuits in exchange for a share of the outcome. Okay. So from an insurer's perspective, this changes both the frequency and severity of potential losses, because all of the sudden an insurer's potential loss is much larger than it was initially priced for. You have these, investors going out to litigation firms, and they're funding these litigations in hopes that the payout or the jury verdict is in their favor and that they get to take a huge chunk of that payout.
I feel like New York City would be especially exposed to this dynamic.
Yes.
Am I right?
Yes, Katie, you're right. New York City is definitely exposed to this dynamic. Not only because it's one of the greatest cities in the U.S., but because only 4 states made up the majority of nuclear verdicts over the last year. And New York State was one of those 4 states. And when you look at the data coming out of New York State, you see that there's a high concentration of nuclear verdicts coming out of New York City specifically.
That makes sense. I mean, the city is dense, it's highly regulated. It has a large rental population. You, me, all our friends. And historically, like we said earlier, it's been more of a friendly,
super plaintiff-friendly.
Yeah. Plaintiff-friendly legal environment, yes. So I think when you're combining that with the political momentum we talked about earlier, tenant rights and accountability, insurers are definitely going to become more cautious around liability exposure in this market.
Yeah, and the data shows that the impact of increased premiums actually isn't even evenly distributed, right? Like, we're not even seeing an even distribution of the rise of premiums.
How is it distributed then?
Right. Yeah. Let me break it down. So the reason premium increases are not evenly distributed across the multifamily asset class is because, take for instance, a higher quality building. They're newer, more efficient. They tend to have better loss mitigation infrastructure in place. And so insurers view them as lower risk. And so that's reflected in their premiums. They have lower premiums. Whereas when we think about older, less efficient buildings like my 5-floor walk-up that is pre-war, those are viewed as having higher risk. And so insurers disproportionately increase the premiums for those older buildings because they're seen as riskier, especially on the liability side.
I feel like, this reminds me a lot of the market terminal. So shameless plug here, but market terminal users are able to actually filter by different asset variables and geographic factors, including what Grace mentioned, like the age and efficiency of a building, and that allows you to compare how similar assets are actually being priced rather than relying on a broad market average. I mean, even if your asset is in the same city as mine, my building, the insurance for it will not be priced the same as yours,
Right. I mean, we are 150
downtown,
blocks
you're
apart.
An uptown girl. Yeah, exactly. I think having that granularity of data down to the zip code is really, really important.
Right. You can see that their prices are changing, not just on a city and borough-wide level, but even at the zip code level, right? You're able to really dig down and try to understand and tease through what could be driving these different changes.
Yeah. I think a bigger thing of what Grace is really saying here is that insurance premiums represent the price of risk. Essentially, when premiums increase by 50 or 60% over a 12 period, the market is telling you that that risk is being repriced. So not randomly, but systematically.
Yeah, correct. Systematically.
Grace, this actually brings up something that we haven't even touched on yet, carrier fragmentation in New York City.
Oh boy. I think before we even dive into carrier fragmentation, I just want to preface that I think a lot of people have the incorrect assumption regarding carrier fragmentation, and they incorrectly assume that fragmentation is really driving pricing movement.
Yeah, I think that's true. I feel like people often also worry about the churn that comes with carrier fragmentation as well. For our viewers, if you look at the carrier league table I'm looking at right now in the market terminal, I think the first thing that really stands out to myself is how fragmented New York City is. Instead of a couple of carriers taking big positions, you have many carriers taking very small pieces of that risk pie. As you can read up here,
there's a lot of insurers in the market.
Yes, and I think that fragmentation can mean a few different things. In New York City, when fragmentation is driven by a carrier's fear for the amount of risk they're taking on, it usually shows up at renewal. So you'll see more churn, more remarketing, and a lot less predictability of pricing year over year. And that all sounds really scary, but not all that fragmentation is really a bad thing. I think some of it's actually very intentional.
Right.
Like in a market with a lot of nuclear verdict action and exposure like New York, these carriers are managing their downside by taking smaller pieces of the market share. That can help keep capacity in the market, even if no one carrier wants to take a big swing, a big piece of the pie. I think main takeaway here is that fragmentation isn't what's driving pricing volatility. It's more so losses, venue risk, and uncertainty that are. And fragmentation is really just makes those pressures show up faster when it's time to renew.
Basically, due to an increase in insurance pricing, insurance is no longer just set it and forget it. Due to fragmentation and churn of carriers in conjunction with price increase, you're saying that's going to be one of the reasons we start seeing a lot of non-renewals this year?
Historically, as you may know, or as our listeners may know, renewal rates are often pretty high, so 80 to 85%. But in New York, we're seeing far more volatility. Policies are being remarketed more often, and pricing moves faster, and those terms can change materially year over year. So you might see an exclusion that you didn't see in the year prior. And that can result in
having to go out and shop more, find a policy that includes more coverages for you.
It results in a lot of churn. I want to do some back of the envelope math here to just give an example. Grace, I want you to help me out with this one. But, okay. So if a property has, let's say, an $100,000 annual premium, it's a huge commercial property.
Okay.
And that premium has increased 50% over the past year. That's $50,000 straight off your NOI.
Right.
Now multiply that across 10, 20, 100 properties. That's a big amount of change you're losing. I mean, what would you say that is?
It's a big number.
And in a fragmented market, if another carrier is pricing significantly lower for that same amount of coverage, you're going to turn to Bob the broker and say, hey, I want that coverage instead. So that gap alone, that small percentage, even if it is just points of a decimal, that can change whether a deal works out or not.
Katie, I think all of that does make a lot of sense, especially when we're looking at our data. As we've kind of spoken about, historically, insurance costs were predictable, meaning that previously when you were determining a deal's viability, insurance estimates were rudimentary. It was $100 this year, it's going to be $100 next year. But as you've explained, and as we've kind of talked about, with the loss of pricing predictability, it's contributing to a much broader market stress, right? It's forcing insurance costs to now be a meaningful factor in loan distress and even in refinancing challenges. But this is not the time to panic.
Don't panic.
Insurance is actually one of the few operating expenses where better data and active management can make a significant impact.
That's what I've been saying, Grace. That is why transparency matters. And I think that's why the advocate terminal matters and is needed now more than ever.
It's true, Katie. It's true. I agree with you.
On the terminal, you're, as I've been saying, but you're able to filter by asset type and zip code and see median pricing and understand how different carriers are pricing similar risk across the market. And that visibility would help any individual who deals with commercial insurance and help them make informed decisions rather than just relying on assumptions or even the word of mouth from their carrier or their broker.
Right, because like when our broker gives us the price of insurance, we don't know, necessarily maybe who they've shopped around to. They're just taking the number as the carrier gives them, right? They don't even have a full view into what the market looks like.
Yeah, they may have a look into, their own internal database,
right,
but it is not market wide, and you cannot oftentimes go to one broker for multiple asset types in a multitude of cities and
totally.
zip codes. But that's changing. So once again, this is an extremely powerful tool, whether you're operating in New York City or anywhere else. It helps you see how the policy direction we're talking about today or litigation behavior and market structure actually intersect to drive insurance pricing instead of just guessing or, relying on vibes. And if you're operating in New York City, those forces matter, whether you agree with them, like them, or wish they would just, go away after their mayoral term. So takeaways from today's episode. Grace, let me know if I'm missing anything, but property and liability coverage are no longer moving in tandem.
Correct.
And the factors driving those prices of property and liability insurance are now materially different. So as a result, we do not see liability pricing in New York City leveling out in the near term, given all of those legal, political, and economic factors at play. Grace, anything to add?
I think to close this out, really, I think the last 2 points would be increased market fragmentation isn't driving price. It's driving market volatility and the rate of non-renewal. So that's really key. I would also say as we look ahead to future deal volume, we should know that when the price to protect against risk rises, total business deal costs rise, and deal volume activity can definitely take a decline as a result.
We spend all day drilling into insurance data across multifamily assets throughout the United States. And we are so excited to finally bring those insights out of the platform, out of our office, and into the market. Grace, thank you so much for walking through the data with me today. It's been a real pleasure. And thank you to everyone for listening. We will be back with more market-driven insights soon. This has been the Advocate Insurance Desk.